Welcome back to Berich. The newspaper Mint did a bankers conclave recently, in which the Reserve Bank Governor Shakthikanta das spoke. There was a fireside chat in which Shakthikanta das expounded his views. I am afraid I don't agree with what Shakthikanta das says. Shakthikanta das says, though he is wary of inflation, the biggest problem is growth slump. He claims that the Reserve Bank of India saw the gold slump come about 1.5 years back and they are all been proactive in cutting rates. Shaktikanta Das should understand that unless money is there in the hands of the people, people will not go buy and consume. He is urging banks to lend more. Just because banks lend more, it will not stimulate consumption. If people are scared of their livelihood and people are not sure they will get new jobs and people are afraid of losing jobs, then they will hold on to money and they will not spend. And that money will go into the pillow. People are not going to borrow and consume if they are not sure they are going to retain jobs. If I do not know whether I am going to work for 3 months, I am not going to take an auto loan for 5 years. All the measures Mr. Das has done has made sure my auto loan will go down by 50 rupees or 100 rupees. I am talking about the recent policy. The problem in the auto sector is most of the loans in the auto sector was done by the non-banking finance companies. After the collapse of ILFS, Altico Capital and DHFL, no mutual fund wants to lend to these NBFCs. Funding for NBFCs through mutual funds has dried up and they have gone off the market. Most of these automobile clients to whom NBFCs were lending will not be funded by banks as there is no proper income proof. So, by just opening a new window and pumping 1 lakh crores into the market or by cutting rates, Shaktikanta Das is not going to achieve anything. In fact, he is going to make things worse because deposit rates have already dropped to 6. If Reserve Bank cuts rates further, deposit rates will drop to 5, less than 6, and with TDS will be nearing 5. With inflation at 7.59, inflationary expectations at 6.5, one can be sure that depositors are the losers. India does not have a social security scheme or a universal pension. Most of the retirees today are dependent on interest on their fixed deposits to survive. By mindlessly cutting interest rates and making deposits cheaper, he is not doing anybody a favor. With rising inflation, he is making old people without a safety net will struggle to make their ends meet. However intelligent Shaktikanta Das may be, the Reserve Bank of India cannot solve the structural problems in the Indian economy by easing credit. Even if he gives credit at zero, people should be willing to borrow. As long as people have to return the borrowed money, consumption is going to not take off in a big way. For consumption to take off, government has to rationalize indirect taxes. Government has to put money in the hands of the people, and government must set its finances right. Unless the finance minister is willing to do all this, the markets are not going to listen to her. The only anomaly so far has been that the stock market has been on a tearing high based on easy liquidity money flowing in from abroad. Last year, there was a tightness in foreign funds flowing and the markets corrected. As America began to cut rates, foreign funds started flowing into India, chasing about 25 to 30 companies. Now, things for coronavirus scare has made foreign capital scarce, and money is flying away from risk. Money is flying into gold, and money is flying into dollar. This has made sure that world markets will correct badly. As I speak to you today, the markets have corrected from 12,200 to 11,600. In fact, as I am speaking, markets are trading at 11,550. This means the Nifty is below 100 points from the lows of the budget day. Still, valuations are stretched. Still, there is a long way to go. However, it is time to keep your watches ready and think about buy. You can start looking at stocks. ITC is trading at 196 and I bought some in ITC yesterday because it's of my favorite stock. Does not mean that you have to buy ITC, nor am I a SEBI registered advisor. All I am saying is quality stocks will become valuable if this trend continues for a couple of months. There is no hurry to catch a falling knife. There's going to be a plenty of time. Get your list of stocks ready, get your watches ready. Thank you for watching Berich. If you like this video, kindly subscribe to my channel. The comment sections below are open for your comments. If you'd like to purchase my books, kindly your number to my WhatsApp number given below. My team will get in touch with you. If you want to contact me, please send a mail to berich@gmail.com and my team will respond to you. Once again, I thank you for supporting Berich.